For years now, there's been one topic, just one, that has been giving insurance CFOs sleepless nights: IFRS 17. I'm telling you, this is not just some small update. It's a complete revolution in how insurance companies all over the world have to report their finances. But let's cut through all the jargon. What does this massive change actually mean? Well, we're about to find out by cracking the code on three big problems it both creates and tries to solve. So here's our game plan for today. First, we'll look at why the old system was just, well, broken. Then we'll introduce the absolute heart of the new rules, this thing called the CSM. From there, we dive into the really juicy stuff. Three big challenges. You've got a profit paradox, a tricky risk puzzle, and a bit of a double reporting dilemma. And you'll want to stick around to the end because we'll see how this one accounting change has sent massive ripples through the entire industry. All right, section 1. Let's start with the most basic question. Why change anything at all? Before we get into all the complex new rules, we really have to understand why the old world of insurance accounting was just not working anymore. You see, under the old standard, IFRS 4, it was basically the Wild West. Seriously, every country had its own local rules for accounting. This meant trying to compare an insurer in, say, India with one in Germany was like comparing apples and oranges. It was just impossible for investors to figure out who was actually doing better. So, IFRS 17 comes in, sweeps all that mess away, and gives us a single global rulebook. The goal? Simple: to finally get everyone speaking the same financial language. Now, right at the very heart of this new standard is one single game-changing idea: the Contractual Service Margin, or CSM for short. Honestly, if you only understand one thing about IFRS 17, make sure it's this. So, what on earth is this CSM? Well, in simple terms, it's the total profit an insurer expects to make from a policy over its entire lifetime. And this is the crucial twist, it's profit they haven't earned yet. And because it's unearned, it gets put on the balance sheet not as an asset, something you have, but as a liability, something you owe. And this quote just hits the nail on the head. You see, under the old system, an insurer could sell a 20-year policy and, boom, book a massive profit on day one. IFRS 17 puts a full stop to that. It says, whoa, hold on, you haven't provided 20 years of service yet, so you can't recognize 20 years of profit. The CSM is the tool that forces them to release that profit slowly, bit by bit over time. And this leads us straight into our first big problem. The idea that future profit is a liability? It sounds completely backwards, doesn't it? Let's break it down with a simple analogy. Okay, just imagine the CSM is a profit piggy bank. When an insurer sells a profitable policy, all that future profit gets locked away inside this piggy bank, and it sits on their balance sheet as a liability. Then, each year that they provide insurance cover to you, they get to smash the piggy bank just a little bit, taking a small amount out and counting it as that year's income. But here's the key. This is a one-way street. If a policy is going to lose money from the very start, you can't hide it in a piggy bank. That loss has to be recognized immediately, up front. All right, let's move on to our second puzzle. At its core, insurance is all about making a bet against uncertainty. So how do you actually put a number on that uncertainty? This is where another key IFRS 17 concept comes in: the risk adjustment. The risk adjustment, or RA, is basically a safety buffer. Think of it as an extra pot of money the insurer has to keep aside just to handle uncertainty. What if a cyclone is much worse than expected? What if medical advances mean people start living much longer than predicted? The RA is the cushion they hold just in case things don't go exactly to plan. And this is where it gets really interesting, especially when you compare it to other big regulations like Europe's Solvency II. Solvency II is very prescriptive. It gives insurers a strict formula and says, here, use this. IFRS 17 is the complete opposite. It's principles-based, which basically means it says, look, you need a safety cushion, but you have to decide how big it should be based on your own view of the risk. It doesn't give you the answer. And of course, this freedom leads to huge variations in how companies actually behave. Just take a look at this data from Australia. You've got an insurer like Zurich being super cautious, setting its cushion at a 90th percentile confidence level. Very conservative. But then you look down at Swiss Re, all the way down at 55%. They are both following the exact same standard, but their interpretations are worlds apart. This reliance on company judgment is a massive and, let me tell you, controversial feature of IFRS 17. Now, this difference in approach leads us directly to our third big problem. Insurers, particularly in Europe, now have to deal with two completely different sets of massive rules at the same time: the accounting world of IFRS 17 and the regulatory world of Solvency II. It's a real headache. And to understand why this is such a problem, you have to realize they have totally different goals. IFRS 17 is designed for investors and analysts, right? To give them a clear, transparent picture of performance. But Solvency II, it has one job and one job only: to protect policyholders by making absolutely sure the company cannot go bankrupt.
And different goals mean different rules. It's as simple as that. As you can see here, IFRS 17 uses the CSM to smooth out profits. Solvency II doesn't care about that. IFRS 17 lets companies choose their own interest rates for discounting. Solvency II tells them which rates to use. And as we just saw, the risk buffers are calculated in completely different ways. The end result? Insurers are forced to run two parallel sets of calculations, which gives them two very different views of their own business.
So what does this actually look like in practice, with real numbers? Well, a major study found that for life insurance, the liabilities under IFRS 17 are about 2.5% lower than under Solvency II. But just look at non-life insurance, stuff like car or home insurance. It's the complete opposite. The liabilities are almost 10% higher. The key takeaway here is that these two rulebooks can give you wildly different results. You just can't assume one is a good proxy for the other. Finally, let's just zoom out and look at the real-world ripple effect. Because make no mistake, this was not just some simple accounting exercise. For many, many companies, implementing IFRS 17 was one of the biggest, most expensive, and most painful projects they had ever taken on. Man, the hurdles were immense. Companies had to dig up incredibly detailed data, sometimes going back decades. This meant they had to completely rebuild their old IT systems from scratch. It also forced teams that traditionally lived in separate worlds, like finance and actuarial, to start working together in entirely new ways. And the cost? For many big insurers, the final bill was just as big as it was for Solvency II, a project that took the better part of a decade. And don't just take my word for it. As this quote from Deloitte puts it, "This was never a simple compliance task. It was a fundamental rewiring of the entire engine room of an insurance company, its data, its systems, and all its processes. A total transformation." So, at the end of the day, where does all of this leave us? IFRS 17 started with a really noble mission: to create a single, transparent financial language for the insurance industry worldwide. But after all the work, all the cost, with so much judgment and interpretation left in the hands of individual companies, you have to ask yourself, did we really create one language, or did we just create a dozen different, confusing dialects? That, my friends, is the billion-dollar question the industry is still trying to answer.